I own QQQI. I don't own QQQ. And half my comment section thinks that makes me an idiot. Mikey, QQQ is the better fund. Everybody knows that, which is cool. I'm not even arguing. QQQ probably does win the total return race over 30 years. So why do I own the other one? Because I'm not asking the question they're asking. They want to know which fund wins. I want to know which fund has a job in my life right now. Those are two completely different questions. And by the end of this, you'll know exactly which one you're supposed to be asking. Real quick, I'm not a financial advisor and none of this is advice. 30 years in, this is just my recipe for my own money. Yours might need different ingredients, so taste test everything before you cook with it. Here's the fight. One camp says, buy the NASDAQ, let it run, never touch it, pure growth. The other says, get paid every single month and live off the checks. Pure income. And people act like you gotta pick one and swear loyalty. You don't. The way I run my portfolio is in buckets, 3 of them, each with a job. A growth bucket, a dividend growth bucket, and a high income bucket. I've broken the full system down in other videos on the channel, so I won't rebuild the whole thing here, but it's the key to this entire QQQ versus QQQI fight. Because these two funds aren't rivals. They live in different buckets. QQQ is a growth bucket play. QQQI is a high income bucket play. Different buckets, different jobs. One builds the pile, the other turns the pile into a paycheck. The reason I own QQQI and not QQQ isn't that I think QQQ is bad, it's that my growth bucket is already handled somewhere else. And what I wanted from this slot was cash flow. That's the whole confession. Now let me show you what's actually happening inside each one, because most people buying these have no idea. QQQ is simple. You're buying the 100 biggest non-bank companies on the NASDAQ. Your Apples, your Nvidias, your Microsofts. That's it. It's dirt cheap to own. It barely pays a dividend. And the whole point is one thing. The price goes up over time. Pure growth engine. You make your money when you eventually sell. QQQI owns basically the same neighborhood, the same giant tech names, but then it does something extra. It sells options against those stocks and uses that premium to cut you a check every single month. Think of it like this. QQQ and QQQI have the same engine under the hood, but QQQ is built to go flat out. No brakes, top speed. QQQI took some of that top end speed and traded it for a machine that pays you while it idles. Same engine, different transmission. And that trade, speed for income, is the entire conversation. When the NASDAQ is screaming higher, QQQ pulls ahead because QQQI capped some of that upside to fund your monthly payment. When things go flat or sideways, that monthly check starts looking really good. But stay with me, because if you zone out on this next part, you'll walk away buying a paycheck that's really just a slow motion refund of your own money. That's the trap, and it's coming. So let's talk real math, because this is where people get sold a dream. The pitch you'll see is, look, if you reinvested QQQI's monthly checks, it keeps right up with QQQ, and you get the income and the growth. And over the last stretch, honestly, the numbers aren't that far apart. But hear me, because this is the honest part nobody says out loud. QQQI is barely 2 years old. And those 2 years happen to be a monster bull market for exactly the tech stocks it holds. That is the easiest possible environment for this fund to look good in. Showing you a 2-year chart from a raging bull and calling it proof, that's not analysis, that's marketing. In a nasty, choppy, sideways decade, that same story could look very different. So don't let anyone, me included, show you a short chart and call it destiny. Respect the strategy, respect the sample size more. Now the spicy one, return of capital. This is what your smart commenters keep bringing up, and they're not wrong. Here's what it means in plain English. A big chunk of that juicy QQQI check isn't dividends and it isn't profit. The fund is literally handing you back some of your own money. Some recent months, almost the entire distribution was return of capital. Now, is that bad? Not automatically. And I want to be fair, both sides, because this is where the hype channels and the hater channels both lie to you. The good side, return of capital, can actually be tax smart. A lot of the time, you're not taxed on it the year you get it. It's treated as getting your own money back, not profit, so the tax can get pushed down the road instead of hitting you now. And the type of options this fund uses gets its own tax treatment that can work in your favor. For the right person in the right account, that's a real edge. The risk side, if a fund is paying out more than it's actually earning, then return of capital is just a polite phrase for slowly feeding you your own principal. So the number that matters isn't the yield on the thumbnail, it's whether the fund's share price is holding up over time while it pays you. Big checks, but a quietly bleeding share price, that's not income, that's your own money back with a bow on it. Getting capital back can be a smart tax move or a slow leap. And the only way to tell which is to watch whether the fund is out earning its own payout. I'm not your tax guy. Go talk to a real one before you build a plan around any of this. Quick heads up before we keep going. In a couple minutes, I'm gonna show you exactly what I'm doing with the 10 grand I pulled out of JEPI, and it's not going where you'd bet. So hold that thought. Because first, the question I get most, where do you even hold this thing? Brokerage or retirement account? Here's the mental model. It's a location problem, not a strategy problem. Right fund, wrong shelf is a real mistake. In a regular taxable account, QQQI's whole tax structure can make it a smoother pay my bills fund than selling QQQ shares every month. You're getting cash without having to sell anything, and some of that cash is tax friendly. If you plan to actually live off it, that matters a lot. Now flip it. In a Roth, where everything's growing tax-free, that tax efficiency magic mostly stops mattering. At the point where you're just choosing income versus growth on the raw merits. Same fund, totally different answer depending on the shelf you sit it on. So don't just ask, is QQQI good? Ask, good where? So who wins? Wrong question, and you knew I was gonna say that. They don't compete, they relay. Here's the whole thing on one page. QQQ is your accumulation engine, the pile builder. If you're young with decades ahead, that's most of your money. There's no debate. QQQI is your income sleeve, where the pile turns into a paycheck. When you're 25, you want almost all engine. Maybe you hold a little QQQI just to learn how the check feels. But as you get close to retirement, you glide. You slowly shift weight from the growth that builds it towards the income that pays you. So that when you finally stop working, you're getting paid every month without being forced to sell a single share in a bad market. That glide from built it to get paid is the actual retirement strategy. Not a fund, a glide. QQQ builds it, QQQI pays you. Both win. Trying to crown one bucket the winner was the mistake the whole time. All right, investing in public, real time, real account. Some of you remember I sold about 10 grand of JEPI, and I said I was deciding where it goes next. Here's the honest update. I still haven't bought anything with it, and I'm going to tell you why, even though it kind of undercuts this entire video. That 10 grand is probably not going into QQQI right now. It's probably going into Glazed, my product brand, because I'm in talks with some brand partnerships that could mean a much bigger production run, and inventory eats cash. That's my investing DNA on the table. I preach the income sleeve. I believe in it. But right now, the highest return on my dollar isn't a fund. It's my own business in a window that won't stay open. QQQI will still be there next quarter. This opportunity might not. That's the trade I'm actually making out loud, win or lose. When I pull the trigger on the shares or the inventory, you'll see it here. So here's where I land. Are dividends smart? Wrong question. Does QQQI beat QQQ? Wrong question. The only question that matters is, what does your money need to be doing right now? Building the pile or paying you? Answer that one honestly, and the fun basically picks itself. The people yelling in my comments aren't dumb. They just answered that question for themselves and assumed the answer's the same for you. It isn't. Don't build a stranger's portfolio. Build the one your actual life needs. If this one clicked for you, you're my kind of person. Here's what to watch next. I just dropped a video on the $1,000 a month dividend myth. The real numbers of how much you'd actually need invested to pull $1 grand a month in income, and why almost everybody guesses it wrong. It's on your screen right now. Go watch that one, and I'll see you over there.